Bosch has extended the contract of its chief executive officer, Stefan Hartung, by 5 years, keeping him in the top job through 2031. The move signals the company's preference for continuity at a time when it is navigating sizable market headwinds, strategic shifts and cost pressures. The extension comes as Bosch confronts a challenging environment in its core automotive business where demand softness, rapid technological change and rising competition have created a significant cost gap. Management has outlined a multi-billion euro challenge tied mainly to automotive operations and announced workforce reductions and restructuring measures to close that gap. Against this backdrop, the supervisory and board decision to retain Hartung reflects confidence that stable leadership will help execute a complex, long-term transformation. Why leadership continuity matters. Bosch is more than a supplier. It is a diversified engineering and technology group with long product cycles and deep industrial partnerships. The company's governance, with significant influence from long-term oriented stakeholders, favors steady, patient management rather than abrupt strategic pivots. Extending Hartung's mandate gives him the runway to implement multi-year plans, including cost restructuring, investments in electrification and software, and expansion in non-automotive areas. Strategic priorities for Hartung. Over the extended term, Hartung is expected to balance several competing priorities. First, closing the structural cost gap in the mobility division will likely remain the immediate focus, requiring tough operational decisions and potential portfolio realignments. Second, accelerating the company's pivot to software, electrification and connectivity is vital. Bosch must convert decades of hardware strengths into competitive software-enabled offerings. Third, the company appears to be diversifying further into building technology and home comfort solutions, pursuing acquisitions and scale to offset cyclical weakness in automotive. Executing on these strategic bets without eroding core capabilities will be a major test. Stakeholder implications. For employees, the extension may offer reassurance that leadership will pursue an orderly transformation rather than frequent executive turnover. For customers and suppliers, it indicates continuity of relationships and long-term commitments. For financial stakeholders and partners, including lenders and industrial collaborators, the move signals that Bosch intends to see through both cost adjustments and new growth investments with a consistent strategic hand. Risks and caveats. While continuity has advantages, it also concentrates accountability. If the strategic investments and restructuring do not yield the expected improvements, criticism may build around both direction and execution. External risks. Cyclical downturns in auto markets, supply chain shocks, and geopolitical uncertainty will still constrain outcomes. Additionally, while the reported extension was widely covered, the company's formal announcements and the precise terms of the renewed contract may contain important details not immediately apparent in early reporting. Bottom line. Extending Stefan Hartung's contract to 2031 is a clear signal from Bosch. The company favors steady leadership to navigate a difficult transition rather than frequent change at the top. The added time gives Hartung the chance to implement long-horizon strategies, cutting costs where necessary while investing in new growth engines such as electrification, software and building technology. Whether this bet pays off will depend on disciplined execution, the ability to adapt to fast-moving technology trends, and how well Bosch manages the social and operational impacts of large-scale restructuring.